Hello, welcome to Coalition Greenwich's continuing series of Behind the Market Structure. I'm Shane Swanson, Senior Analyst with the Market Structure and Technology Group within Coalition Greenwich. I'm very fortunate today to be broadcasting from the boardroom within the New York Stock Exchange. As everyone knows, the New York Stock Exchange has a storied history, 229 years, and has companies boasting approximately $35 trillion in market cap. At its helm is our guest today, Stacey Cunningham, who is the president of the NYSE Group, which includes the New York Stock Exchange. So thank you, Stacey, for having me here today. I really appreciate it.
Thanks, Shane. It's great to see you.
Wonderful to be here in person. As we were saying earlier, it's very interesting to be able to travel again. It's my first trip back to New York, so thank you for hosting me.
Our pleasure.
One thing I'm sure all of our viewers know, but I figure we'll give you a little bit of your background and history. As you started in the industry as an intern here at the New York Stock Exchange, is that right?
I did. Back in the mid-90s, I started my career on the trading floor. I was studying engineering, didn't expect at all to get into this industry, but interned with a trading firm on the floor. So I didn't work for the exchange itself, but I was on the trading floor and ended up working my way through for the 10 years, spent about 10 years down there as a trader.
Great. And then I know after the New York Stock Exchange, you spent a bit of time away from the industry and then ended up at another exchange, ended up eventually as the head of sales for U.S. Transaction Services. And that's actually where we first met back in the automated trading desk days when I was their general counsel and chief bottle washer and everything else.
Yes, and I appreciate you taking it easy on me as I was getting to learn that side of the business. So yeah, that's right. I spent a few years at NASDAQ. Before I came to actually work for the exchange itself.
Yep, and then back at the exchange in 2015, you became the chief operating officer, and then a few years later became the president in 2018 of NYSE, and so first female president of the New York Stock Exchange. So that's a very dynamic and varied background. So I know we'll get more into that in a bit, but. As a market structure wonk, of course, I want to get into a little bit around the market itself. And whenever I think about how do I learn a little bit more about the market or the industry I'm looking at, first thing I always do is go to the website. So I thought it was very interesting. I went to the New York Stock Exchange website, and on the landing page, the first tab, it shows listings. And if you go to other market centers, they might have market activity, or they might show the other exchanges under their umbrella. And of course, the obvious question is, why does NYSE have listings as the first thing on its website?
You know, it's really who we are at our core. I mean, we're sitting in a building that is right where our country was founded. So this corner, we're at Wall and Broad Street here in Lower Manhattan, and it is literally where this country started. And the first company that was listed on the New York Stock Exchange was Bank of New York, founded by Alexander Hamilton to support his plan to get Congress paid. And so that was, it's really core to our existence. We've been such a big part of watching these companies raise money in the public markets to go out and change the world. And that's been our mission, is to help them do that. And they are literally changing the dynamics in our lives every single day, the way we live, work, and play. And so that really is who we are, and we believe strongly that if we don't lose, we have to always maintain that vision and that focus that we exist and our capital markets exist for companies and their investors to come together, and that's a role we play at our core. So yes, we'll talk about all those other things and the different markets that we run and different asset classes that we trade and new products that are out there, but issuers and investors are really at the core of what we do.
Excellent. When we talk about bringing those companies public, obviously there's any number of ways they can become public. There's the traditional IPO, there's SPACs, there's direct listings. Let's talk a little bit about each of those, because I know that New York has all of those as part of its offerings.
Yeah.
So with the traditional IPO, why do companies choose IPO versus SPAC versus direct listing? Can you give me a little bit of insight there?
Absolutely. And Shane, I think this is the most exciting period of time in the capital markets space and industry than we've seen in several decades. And we've been around for a long time, as we said. But the companies have more choices than they've had before. And a lot of that is driven by their reasons for going public and why that's changed. So if you think about the reasons a company would go public, and initially it was to raise money. Like, that was always the primary driver, was to raise capital so they can grow their business. Secondary benefits that they got were the credibility of a public listing, currency to engage in M&A, liquidity for their early investors and their employees. Those were benefits of being a public company, but it was very rarely the reason that a company would choose to become a public company. That's changed because there's so much access to capital in the private markets and through other means that companies aren't going public because they need to raise money. They're actually going public for those other reasons as their primary goal. Very often, they've been private for so long, and their investors have been invested with them for 10 years. Their employees have been getting paid in equity for 10 years, and they want to be able to have that liquidity event so that their employees can go buy a house. And so that's become a challenge for many companies. It's not the same. It's not one size fits all. They're not all driven by the same exact reasons. But that liquidity is a big driver, especially for many of the companies that are more mature private companies. The other, being able to do deals with your stock is really an important driver for some. And the credibility of a public listing for especially enterprise software companies that are thinking about attracting new customers, and as a vendor, being a publicly traded company makes them more attractive to be able to get those large deals. So if you just take a step back and think about why are they going public and how that's changed, it led to the next question. Well, how am I going public? How do I actually affect that transition from private to public? And so we'll talk about each of them. I mean, the IPO market is tried and true. That's a model that's well understood, it's well known. Your banks will take you out on the road and introduce you to their customers and then work with you to define an investor base that you might want and allocate shares to that investor base, and hopefully you go public that night after the offering, and maybe your stock pops the next day and the market receives you well. And if it pops 100%, people say that's a great IPO, unless you're the one that sold it the night before, right? So there are companies there that really feel like, well, wait a minute, if I'm not going public to raise money, why am I forced to do an allocation at a valuation that might not be reflective of supply and demand in the overall market? So Barry McCarthy, who's the CFO of Spotify, came to us and said, hey, let's talk about this. And so that was how we started to develop the direct listing in concert with them. And that's really there's two major benefits to a direct listing and some additional other smaller ones. But the one was the cost of capital.
Right.
Just reducing that cost of capital, letting the market value the company. Second is the democratization of access. And really, Daniel Ek, the CEO of Spotify, felt very strongly that all of their customers should have all retail investors should have the same access that the clients of the banks that might be underwriting an offering would have. And so the direct listing accomplishes that by letting everyone in on a level playing field with the opening trade on the New York Stock Exchange. We price it, it opens, everybody's in, and it's whoever wants to take part. It's real price discovery. With SPACs, they've been around for a while.
And so the special purpose acquisition company, blank check companies, again, very old, I guess it's an older concept, but I guess in 2017 you saw them kind of getting a lot of traction. 2018, a bit of a lull. 2019, the gas was poured on. In 2020, to the moon, so to speak.
Yes.
Right.
Yes.
So again, what drives that? What have you seen from the New York's position?
Yeah. So SPACs used to be a way for companies to go public that were kind of having a hard time with that traditional IPO process. They couldn't necessarily find their target investors, and so if you think about the original SPACs way back in the day, frankly, they didn't qualify to list on the NYSE. So we didn't start listing SPACs until just a few years ago. And with that, it was a real shift in the sponsors that were coming out to the market with a SPAC, and people are really investing in those sponsors. They're experienced business leaders that they're saying, I trust that this person's going to go find a company that I might want to participate in. There are a lot of protections for the investors because they can get their money back if they don't end up liking the deal. So for a company that is considering their options, what's appealing about a SPAC is they have more control. Mm-hmm. They can negotiate with a counterparty. There's less market risk associated with doing a SPAC because you're negotiating an M&A deal. One of the elements of the SPAC that's been interesting is that there is a safe harbor provision within M&A that allows companies to provide forward-looking guidance, and many of the SPACs were relying upon that since it's technically an M&A deal.
And similar in direct listings, right?
In direct listings as well, more explicitly in direct listings, but in SPACs, it's
part of the M&A.
It's part of the M&A structure, and so technically it's an M&A deal. So as you highlighted, Shane, there were so many SPACs coming to market through 2020. 2021, I mean, on a busy day, might be 20 SPACs launching in a single day. So it was really, really off to a remarkable start this year as well, and perhaps a little too many, from my opinion.
If I've got my numbers right, I think there was something along the lines of 560 through June.
Yes.
So that's an incredible number.
Yeah, incredible number. In April, it came to a screeching halt because the SEC made a couple of statements that gave people a little bit of pause as they were thinking about the SPAC market. One was they made some statements around the accounting for warrants in the SPAC structure. So a lot of SPAC sponsors and businesses took a step back to look at that accounting and perhaps rework that. The other element was they implied that perhaps the safe harbor provision doesn't apply in this case because it's really the first time the company is becoming a public company and not more traditional M&A. And so those were elements that gave the whole SPAC market a bit of a deep
Pump
breath.
on the brakes.
Yeah, it pumped the brakes pretty hard. We are seeing that start to unlock now. We're seeing more companies, business combinations get done and SPACs launch again, but fewer than we saw before, which I think is a healthy reset for the market as you're seeing higher quality companies really coming out to the market. So, I mean, I know we talked a lot about all these different ways. There's a lot of different dynamics between each of them. But if you just think about how, to your first question, how does a company choose or what are the differences? With an IPO, they're getting that tried and true experience, and many companies that choose that path want to choose their initial investor base.
Right. They have that curated process with the bankers.
Yes, yeah, and I think they're thinking if I hand select the investors, I'm going to have long-term investors. I'm not sure that always will hold true because if an investor wants to buy a stock, they're going to do it. They're going to invest anyway, and it's not always true that they're going to stay long-term investors just because they got in on the allocation, despite everything they say. With the direct listing, that forward-looking guidance is attractive, the democratization is attractive, and the cost of capital is really an important focus for many of those companies. And then SPACs, it's more about the control and negotiating in that front, and having that early stage access to, for many companies who were going that path really had a more complicated story that they were trying to tell.
Right. And then I know that there's a new ability that's not been tested, that's been approved. I'd have to actually look at my notes. SR, what is it now?
I don't
SR
know.
NYSE. Anyway, 2019 rule filing that was approved last December by the SEC for a direct listing with a capital raise.
Yes.
So can you tell us a little bit about that? And again, it hasn't been tested yet, but it is out there and approved.
Yeah, so it hasn't been used yet by a company. But so if you think about the initial impetus for the direct listing, it was to decouple capital raising from going public. And so if that wasn't the primary goal, let's just separate the whole thing out and we'll not raise new capital, go public. And you could always raise capital before or after separately. Some companies have said, well, what if I do want to raise capital at the same time that I'm going public and I want that to be part of my process? We worked with the SEC on that for 18 months or so. And filed and received approval at the end of last year to be able to have a primary offering as part of a direct listing. So what that would mean is a company that's looking to raise money would file their prospectus the way you would for a normal IPO, but that offering would happen on the morning of its listing day. So instead of having it the night before through a subset of investors, and have if you think about the challenge that happens during that process, there's a lot of artificial constraints in the IPO process because not all of supply and demand is coming together. You're artificially constraining the demand side because not all investors get allocations, and even those who do get an allocation don't necessarily get their full size of their interest. And you're artificially constraining the supply side because there are lockups that are in place, and so you really don't get to a more mature state of a public company state until 6 months later. With the direct listing, and now with the capital raise, they're saying, let's do that offering in the market and let the market price that offering on the exchange in the morning and really allow, without those artificial constraints, the price discovery to happen. What we've seen in direct listings, even without the capital raise, is they've been less volatile. We expected them to be more volatile. There were lots of people debating whether or not you're going to see more buyers than sellers or vice versa. But we actually saw they have less volatility and they're much larger in size. So the direct listings that have happened so far are among the largest opening trades in U.S. market history. And they're not the largest companies, but you're really, because it's not inhibited in the way that more traditional auctions are, they've been really less volatile price discovery events. The reason why we haven't seen a company take advantage of it yet is it takes some patience in working with the SEC on some of the mechanics of a specific filing. Spotify was willing to spend and invest that time to be a company that would go down, and we went to the SEC with them and worked through that whole process with them. When you're raising money, it's harder to have that luxury of investing all the time. And so the companies that have explored using this and have spent the time with the SEC have found that they needed to raise the money, and they've ended up doing a more traditional IPO instead.
Right.
So we're just waiting for that moment.
The right time, the right company at the right,
Yes.
Right, all the right factors to fall into place.
Yeah, it really addresses, I think, some of the issues, though, that we see in the capital markets.
And once it happens, that kind of greases the wheels, and then you'll see, I think it'll start to be one of the many choices that the companies have as they go public.
Yeah, I mean, that's what we're seeing already, right? I mean,
Right.
Spotify was 2018. There was one.
Right.
Slack was 2019. There was one. There were two in 2020. There were 3 year to date in 2021. And we have more in the pipeline.
Excellent. Well, we talk about choice, and just to change a little bit in direction, one of the things we're hearing a tremendous about in our research and with our clients is the choice that investors are making now when it comes to where they want to invest and how they want to invest. And that obviously brings up ESG, it brings up DEI, so environmental social governance, diversity, equity, and inclusion. These are incredibly large topics. We do a fair amount of research on it. We've done a recent study where we've shown that on the asset owner side, at the very least, over the last few years, the percentage of asset owners that are including sustainable investing has grown by 135%, and over the next 5 years, across all asset classes, it's going to be a part of their sustainable investing process. Is going to be minimum 65% of all investing. So, large swath of the environment are growing, and I did actually see you put up a LinkedIn post on the expanding role of ESG.
Yeah.
And so I see that what was the one stat out of many was that in earnings calls you showed that or cited that 20% of all earnings calls mention ESG now, when that was 1% a decade ago.
Yes.
So clearly we see a combination here of the growing interest and demand for this, quite literally, from investors, and the importance of it, I think, from a generational perspective. I have 2 kids who are going to college, and I hear about it every day, how important the environment is, how important social and governance issues are. And so when you think about that from the New York Stock Exchange perspective, what does New York have for its companies as they explore these issues?
So I think there's so much in there, Shane. And
I
one
know
thing,
it's a broad question.
Yeah, but I think one thing to note is this isn't new. I think the way we talk about ESG is new. Connecting some of the dots between different stakeholders across the ESG universe is newer than it had been and growing. But the concept of it isn't new. And if you ask many of the CEOs of NYSE listed companies, they would say you cannot be a successful company if you aren't focused on your stakeholders across and your community and all of these other elements that are largely viewed in the ESG community. And so I think that there are so many aspects of it that isn't new. In fact, the UN's Principles on Responsible Investing was launched in this room 15 years ago.
So I mentioned the website, so I do go to the website all the time. So I saw that 2006.
Yes.
Yeah, you launched that here. And that actually that did resonate with me, that these issues have not just sprung up out of whole cloth. They have been around. They have been something that investors have been advocating for, and companies have been advocating for. I don't want to make this sound like it's one view. It's clearly CEOs are wanting this to happen. Investors are looking for it, and every day-to-day people are looking to make it happen as well. So you mentioned that the NYSE launched that here. So explain a little bit about what that is, and then what else you have.
Yeah, I think connecting all those dots. I mean, like you said, investors are very focused on ESG. Even making sure, I would talk to CEOs and sometimes hear, well, our investors aren't asking us about ESG. We're doing all of these things because of our stakeholders, our employees. Like you said, they want to see the focus on sustainability. And the first CEO that said that to me, I thought, well, that can't be right because I talk to investors and investors are very focused on ESG. And so I think making sure that the right people are in the right place. So we focus on how we think about our role in ESG in a few places. One, what are we doing as a company for our own communities and our stakeholders? And then two, how do we tap into the NYSE community to drive broader change and help them with their own ESG initiatives and the investor base as well. So as you mentioned, I mean, the assets, professionally managed assets in the US that are invested in ESG strategies is 1 in 3 of all dollars are invested in ESG. So clearly that's a focus. Across ICE, we tackle this a number of different ways. And one of the things that we're very focused on is collecting data that can inform that ESG investment. And so we have 500 different criteria that we collect across from public company information. It covers 3,700 companies. And that's different ESG key metrics around ESG. We package that up so that investors, index creators, ratings agencies can all use that data to drive the change that they want to see. And then also we give that data to listed companies at the NYSE so they can not only see how do they stack up versus their peers, what are they not disclosing, how are their suppliers or their vendors stacking up? So if they want to make sure that they're working with others that share their goals and share their insights, that they can use our data to see how they're performing. And so that's all part of the way we can bring in issuers and investors together to get to the same outcome. Because having a good ESG story is not the same thing as telling a good ESG story. And there are so many CEOs I would talk to who would say, we're doing more than somebody else who's being held out there as an ESG, star.
Icon.
Yeah, and we do a lot. We're just not talking about it in the right way. And so we help them with that story and making sure that they're getting their narrative out there, or that they might not realize that they have publicly available data that's outdated, that on a website they didn't know was still existing. And so all those types of things we can work with them on. That's one area of focus. You also mentioned diversity, and that's a big area of focus for us. It's a real passion topic for us. So we launched a couple of years ago the NYSE Board Advisory Council, and that is designed to help change the diversity profile of corporate America by tapping into the community that we have here. And so if you think about board seats, most of them are filled through referrals, not through recruiters, because it's networking that really is what drives a great board match. And so we tap into our CEOs to give us names of board members that they would vouch for and recommend as independent directors, not only people that they may have worked with on boards, but the next generation of board leaders as well, is who are up and coming stars that they've interacted with that they would recommend to go sit on a board. And so then our listed company community can say, hey, I'm looking for a board member who might have, who's in your database that might be a useful person for us to get to know. And they also get to reach out to the CEO who nominated them and say, can you tell me more about this person? So those solutions are just small steps that we can take to really drive more significant change across the ecosystem.
Well, I think that's incredibly important. And again, your own story obviously is important as you think about, coming up in a, what has historically been, male-dominated industry,
Still
right?
is.
And obviously may still be, right? So when you have that and you think about, your story, what would you share with people who are up and coming or in other companies? What focus do you try to bring to that?
Yeah, I think it's important to be yourself, and to what makes us diverse makes us much more valuable. And so I think it's really hard to define diversity because we are very different. We all are the product of so many different factors, and gender or race or social background or geography, those are all single components of what makes us who we are. And it's really that intersection of all of those elements that create us as individuals. And that diversity leads to diversity of thought and new ways of solving problems. And that's why it's so important as a leader to have a diverse management team, as a company to have a diverse board. And so that's such an important area of focus. So when you're outnumbered in an industry, that's a good thing, and you're bringing something unique and valuable to an organization that you shouldn't try and conform, because what's making you more valuable is how different you are. So I think it's really important to just recognize that by being part of an industry, you're really redefining what that looks like, and you're redefining it not just for yourself, but for everyone who follows. So that's been my experience. I didn't focus a lot on my gender even though I was outnumbered, but it definitely had an impact on who I was and how I was able to succeed in different roles.
Right, well, and bringing that different insight, I think, is incredibly important. And I think that idea of making sure others know that it's not only acceptable, but necessary and important to bring those differing viewpoints together is very valuable.
And that's why the equity and inclusion part is so important.
Right.
Because if you think about people's different styles, not everyone is going to be as vocal as others. And so if you have somebody if you want a diverse viewpoint or diverse perspective from somebody who might be a quieter voice, you have to find a way to make sure they're included in the conversation and pull them into it. And so and it was a little bit harder during this COVID period of time when you're on Zoom calls and others to try and find a way to get different team members to speak up that you might not, I may have read their body language in a meeting and called on them. And so, we all had to navigate that. And in some ways it's been helpful for some people, and in other ways a little bit challenging. But that inclusion part of it is so critical.
I think that's incredibly important. And as I think about, things that you might want to change, right? If you had a magic wand, you were just going to wave it around the industry. Is there, anything in particular you would focus on?
Yeah, I think there's one thing that we have not done well as an industry is telling our own story. And one lesson I've learned repeatedly throughout my career is that if you let somebody else tell the story, they're going to write a crazy story. I like to say no Mad Libs, because if you leave blanks in the stories, people will fill in the blanks, and they'll come up with a narrative that isn't reflective of the truth. And it is so much harder to change a narrative than to just write the narrative. I think it's true when I think about some of the decisions or elements in the exchange business at NYSE, but in capital markets and finance more broadly. We need to make sure we're telling the story of all the good that gets done when companies are raising money. And we need to focus on the fact that capitalism is not a bad thing, but it needs to be a story of shared success. And we need to make sure we're still capturing all of the investors that should be part of this story so that they can share in that success. And I think we see a lot of frustration with elements of our markets that you're seeing it manifest out in different ways, whether it be meme stocks or even a fight for direct listings or others. People want to feel like they're part of it. And I think it's on us to tell that story a little bit better.
Oh, very good. Thinking in terms of magic, I think one of the magic things we do have in the industry sometimes is how technology does tend to help solve some problems, right? We have data.
Yeah.
You can use data to tell stories. We have technology, and one of the things I know NYSE has been doing is recently been updating its technology. It's many years into a multi-year project, right? That I think actually you may have kicked off as COO,
Yes.
the Pillar platform.
Yes.
So I know Pillar has rolled out in equities. Oprah is on, I think Oprah, right?
Yeah, yes.
I always want to say Oprah is on it, and options are going to be coming out on it as well. So when you think about the technological solutions that NYSE has too, tell me a little bit about, first of all, what does Pillar provide, and where do you see technology taking the exchange?
Technology has to be at the core of everything we do, right? In every business, it's true that way now too, right? I mean, you can't really be in any business without being focused on technology. But our systems are so critical that you have to be prepared for whatever the markets might throw your way. Nobody expected a global pandemic to be unfolding a year ago. And what we saw in the market, that rapid activity, I was pretty happy to know that we had migrated all of our systems onto the Pillar technology in advance of that. It's one scalable, deterministic platform that's really consistent performance, I should say. That's really critical for our customers for so many reasons, because no matter what the market conditions are, the system operates the same way. If you think about the way our equity markets have evolved since you and I have known each other, Shane, they're much more fragmented. A lot of price discovery is happening on the exchanges, and the market makers are really setting those prices and very often on exchanges. And that's a sophisticated risk management exercise. And if the system doesn't perform the same under all conditions, they're going to price that risk in. And that's going to lead to worse prices for investors. And that's really critical to make sure that no matter what is happening in the market, the system is always as responsive as it is in quiet conditions. It's the equivalent of if a system slows down, it's like not answering the phones in the 80s during the market crash. You need for it to be the same. So Pillar provides the most consistent exchange technology out there. It's low latency and most what we heard from our customers during those periods of volatility is that our markets performed the same way as all normal conditions, and that they were happy to see that. And so it was very rewarding to see so much time and energy that had gone into designing the system that's really scalable and determine, high performance system, and see it live. It also was really encouraging to see how well all of the technology performed when you work so hard on all these BCP programs that we have. Whether it be market-wide circuit breakers or other things that are less exciting projects to work on, frankly, because you're only using them if you're in a crisis, and so you're not seeing them live. But we tested all of them, and we tested all of them last spring, and everything worked flawlessly, even closing the trading floor and moving to completely electronic trading, which we obviously know how to do that. We run 5 equity markets, and only one of them has a trading floor. But we hadn't ever run the New York Stock Exchange with the floor closed, and we actually saw some really interesting data from that as well.
Well, and I think that's interesting as you look through, the effects of the pandemic, and not only just personal effects to everybody, but how that has affected the markets, right? How will they evolve from here going forward? You had that case study now.
Yeah.
Of what do the markets look like when the New York Stock Exchange is fully electronic versus when you have the floor? So, what did you find when that happened?
Yeah, it was really interesting, and it's not an experiment I ever would have chosen to run. I wouldn't have
Fair.
signed up for it. But if you think about the model at the NYSE, it's really unique, and we take 3 unique components: the technology that we talked about, which had to operate under scale. I mean, we were processing on a peak day 356 billion messages in one day. Just let that sink in for a second. I mean, that is a lot of activity. So clearly, people aren't going to be processing all those trades. We're using algorithms and all that. So it's the technology, accountability, and that's every company that's listed on the New York Stock Exchange has a designated market maker, formerly known as a specialist. And that role comes with a higher obligation than any other market maker in the US markets. And third is the human judgment. So those DMMs are using technology to trade, but then they also have a human being on the floor who's interacting with institutional brokers on the trading floor at point of sale. It's the combination of those 3 components that really creates the market model at the NYSE, and it's really unique. We know stocks trade better at NYSE, but we didn't know how much of our outperformance came from the accountability nature of the DMMs or the human being nature of it. And so when we closed the trading floor, you could see that the DMMs still had their same obligations to meet. They had to quote, they had to have the best quote in the market a certain percentage of the time. They had to do all of the same standards that they had to meet. They were just fully electronically meeting those obligations. So we were just missing the people there. And the study that you referenced showed that stocks still traded better than other fully electronic exchanges because we do have that accountability, but not as well as when the trading floor was open. So we saw that there is value from both pieces. Unique value that comes in, especially around critical moments like the open and closing auctions is
Right.
where we definitely saw a lack of more reduced liquidity and activity around the auctions.
And we've seen auctions have become more and more important. We see there are all sorts of different market models now that are trying to do periodic auctions, or they're doing on-call auctions. Any thoughts that the NYSE will add more auctions to its?
We're always looking to meet the needs of our customers and see what is valuable for them. The closing auction at the New York Stock Exchange is the largest liquidity event in the world, right? And so there is real magic that happens there when you think about how you price securities, and I think it's certainly a keystone of what we're able to provide investors. But we're always looking for what are the new tools that we can deliver to investors that are helpful for them as they're trying to navigate today's markets, which are more complex than they used to be.
Fair. Any last thoughts, Stacey, as we're wrapping up here?
It's just great to have this conversation live, and I think it's really important for us all to work together as an industry. I think there's a lot of talk about market structure and what might change, and are there areas for improvement? And we're open to having all those conversations and looking for ways to make sure we're delivering the best results. And I think we should just need to make sure that the issuers and investors are part of that focus as we develop those solutions and work toward delivering the results that really are what make our U.S. capital markets so unique.
Outstanding. Well, thank you very much for having me, Stacey. I'd like to thank everybody for tuning in today. This has been a treat to actually be here in person, to be able to be at the New York Stock Exchange. I'd like to thank all of you for watching. If you have any follow-ups, you can please reach out to Coalition Greenwich for any of the topics we discussed today. And I hope everyone has a great day. Thank you. Bye-bye.